You will never get a loan modification if you are current because you don't have a hardship for the bank. What that means is that if you are paying your mortgage on time, the bank does not consider that you have a hardship. Therefore, you cannot apply for a loan modification and successfully get one. That's something that a lot of people can't understand. They think, well, in the future, I won't be able to pay it. I'm trying to get a lower interest rate, a lower payment. But they keep applying and they keep applying, they keep getting denied for that simple reason. I'm gonna teach you a couple things about how this situation works out for a lot of people and how you can use it in your favor to possibly get a loan modification. My name is Mendez. I'm a loan modification, foreclosure, and bankruptcy lawyer here in Miami, Florida. I've been helping people since 2008 with this exact same issue. I've counseled thousands and thousands of people with their loan modification and mortgage issues in hopes of them saving their homes or making decisions of getting rid of homes they can't afford. Please subscribe to my channel, Debt Law Survival Guide for the Desperate Debtor, and like my videos, and I'll keep making these videos for you and for other people who are dealing with the financial crisis of the coronavirus and other problems in their lives. So I've talked about this issue in a couple other videos. Specifically, when you are current on your mortgage, the bank does not consider that you have hardship. I understand a lot of people are looking forward and they're saying, okay, well, I can't actually afford this mortgage payment, so I'm gonna try to save my credit and I'm gonna try to get a lower payment now by asking for a loan modification even though I keep paying my mortgage every month. When you do that, the bank will always deny you, because the bank does not think that you have a hardship. Now, there's only one exception to this. That's when you're in forbearance. A lot of people right now are in forbearance. If you're in a forbearance, many times the bank will consider your loan modification application because they consider you an imminent threat of default. So basically, you've already defaulted in their minds, so you need the help from a loan modification. If you're in a forbearance, you should attempt to get a loan modification through the bank. Now, a lot of times, the bank will still say no because they don't offer loan modification while you're in a forbearance. This is an unfortunate situation. They're basically telling you you have to default in order for you to get a loan modification. In 2008, a lot of banks were telling people you have to stop paying in order for you to get considered for a loan modification. I do not recommend this because this is a train that you cannot get off. Once you get on the default train, it's very difficult for you to ever become current on your home. There's actually a term. It's called a strategic default. A lot of people were in a situation where they were unable to pay their mortgage in the 2008, 2009, 2010, and they decided to do something called a strategic default. A strategic default basically is planning your default, planning to stop paying your mortgage so in hopes of getting a loan modification in the future. Now, why is that a bad idea? Number one, the whole premise of a loan modification is your income has gone down, therefore you are eligible for a lower interest rate and extension of term and some other manipulation of the mortgage so that you can get a lower payment. The problem is that if your income has not actually gone down, then you're not really suffering a hardship. All that's going on in your life is you're looking forward and saying, okay, I want a lower interest rate. Right now, interest rates are very low. You might not be able to refinance your home because your credit isn't good or some other reason, so you say, well, I'm gonna try to get a loan modification. Now, the problem is that if you're paying it, there's no hardship, and the bank knows this. So the problem is that when you're in this situation, a lot of people are gonna tell you, oh, well, just default. You know, if you default, then the bank will be forced to deal with you and give you a loan modification. The issue is that if you default with the same income that you had before or a higher income, the bank will not give you a loan modification. Your payment has to go down in the loan modification calculation. If your payment goes up because your income is higher than it was before, remember, it's a percentage, usually 31% of your total monthly income. So if your 31% calculates a higher number than your actual mortgage payment right now, then that means you will not get a loan modification even if you're in default. So this is a very tricky thing you need to deal with. Now, Most people who are looking for a loan modification are not strategically defaulting. What they're doing is basically in a situation where they cannot afford their home. So the question to ask yourself is, can I actually afford this house? That's the biggest question and the most important thing that you need to ask yourself when you're dealing with a mortgage default situation. If you're looking at your income and you do not think that you're gonna be able to make the next mortgage payment or the one after that or the one after that, then the biggest thing to look at is your lifestyle. Now, if it's because your income has gone down because of COVID and you think that later on maybe your income is going to go back up, well then it's possible that your income will go up. You should make the sacrifice right now to keep paying your mortgage, and then at the end of the hardship period, you're going to be able to pay your mortgage no problem. However, if you do not think your income is going to come back, or you're in a divorce situation where there was two breadwinners, now there's only one, or there's a sickness which causes somebody to not be able to work for a long period of time, then it's not a strategic default you're dealing with, it's an actual default. If you are in a situation where you can actually not afford the house anymore, then there is really no choice, and you should consider what you need to do with the home. If you default on the payment and you have some income, then you might be able to get a loan modification. The biggest question and the biggest problem people have in this particular situation, when they are unable to pay their mortgage, but they have savings, specifically 401k or other savings in the bank, and they have defaulted and they're unable to pay their mortgage, and they look at their savings and they look at their 401k and they decide to do something, which is to take that money that they have saved to cure a default. Now, this is a very tricky situation and something you need to really think through before you use, especially your 401k, to pay off a default and to bring your mortgage current. If you have money in your 401k and you're taking that money out to cure a default on a mortgage that you cannot afford every month, without this extra money coming in from a savings or from some other source, then you are not helping yourself. What you're doing is you're taking good money, which is your 401k, putting it into a bad situation, which is a house you can't afford, and you will end up defaulting anyway. So you'll lose your money in your 401k and you'll lose your house. This is the same situation if you have money saved. If you have money saved, you have to be very careful about taking that money, putting it into a house that you cannot actually afford the monthly payment. Remember, that monthly payment comes back every 30 days, and it will probably go up because your taxes and insurance are likely going to start going up. There's a lot of that in the news right now. Property taxes are going up and insurance is going up, especially if you live in places like Florida or Texas, or places that are prone to flooding and weather issues. When you're looking at your financial situation and you say to yourself, should I take my savings and should I cure a default on a house that I cannot afford, think twice, 3, 4, 5 times. You might be better off selling the house, getting the equity out, whatever is left, and then buying something smaller, downsizing, before you start taking money out of your savings and putting it into a property that you might lose anyway. This is a very important decision and something you should look at with your family, with other people that care about you. I'm not a financial advisor, I'm an attorney. I don't help people with financial decisions, but I've seen this situation play out several times where somebody has taken their 401k, dumped it into a house, and then a year later they're back in a foreclosure problem because they can't actually make the monthly payments. Be very careful with the situation. It's a very sad situation, especially for people who are close to retirement. Be very, very careful. Remember, 401k is generally protected from all of your creditors. So you cannot be sued and the 401k money cannot be touched if you are in a certain situation. So be very careful with what you do with your 401k money. My name is Diego Mendez. I'm a bankruptcy, loan modification, and debt lawyer here in Miami, Florida. I've helped a lot of people with these particular issues, specifically with problems with debt, problems with their mortgages, problems with not being able to afford their homes, and solutions that sometimes include getting rid of the house. I'm going to do other videos on this topic, and I'm going to keep talking about this subject throughout the COVID-19 problem that we have right now. Please subscribe to my channel and help me make more of these videos by liking my videos, subscribing to my channel, and leaving comments, which I will try to answer as many as I can with specific problems and questions that you have. Diego Mendez, Debt Law Survival Guide for the Desperate Debtor, here in Miami, Florida, to help you. Thank you.